Are you playing on that just supply demand play, or are you playing on longer term trends that say, I know that those high growth markets, whether it be tax rates, corporate relocations, where people just like to live, are going to drive the economy forward. And therefore, my bet goes there versus going to somewhere where there's just a supply and demand imbalance today?
I always look at the supply demand. High growth markets have a hidden risk. What's the hidden risk? Great growth. Developers get a lot of development fees, right? Lenders get a lot of fees for the construction loans. The units will fill because there is growth. Do you get a lot of value increase in your asset? Nah. And the problem is that demand generally is outstripped by supply in those markets.
Prominent CEOs, leading economists, iconic investors. Insights from the experts. The Walker Webcast with Willy Walker. See who's next.
And another Walker Webcast with my great friend, Peter Linneman. Hi, Peter.
Hi, how we doing, Willie?
I'm great. You mentioned me before we came on air. Someone asked you whether the two of us had done our prep call for our quarterly update, and you and I both laughed at that in the sense that the two of us like walked through what we actually talked about. I will say I was
Rehearsal. We don't need no rehearsal, right?
I was doing my final prep this morning on the exercise bike, and I had my printed out copy of the Linneman Letter, and it looks like it went through the paper shredder because I sweat all over the thing, and I'm writing notes in the margin and all this good stuff. But I do now, after having read it very closely for 5 years, and I'd read it prior to the two of us starting to do this, but obviously I take it with a lot more focus than I used to prior to us starting to do this. And I have to say that there are certain pieces to it that I can now just digest pretty quickly of saying, has his view changed on this piece or is it not changed on that piece?
Of course, exactly.
I can move through it pretty quickly. But with that, Peter, let's start here. I woke up this morning and looked at the, if you will, major indices, the leading indicators, where the markets are today. And you've got, the Dow at 46,627. I use the Dow rather than the S&P purposefully because at least it's not quite as hyped by the tech stocks as the S&P is, and it's still way up there. 10-year at 411, oil at 62.40. And I sit there and look at things like gold, and gold went over $4,000 today for the first time ever. So that's the one sort of kind of flashing red light to some degree. But you're more pessimistic today than you have been in quite some time. Why?
Yeah. I said yesterday to a friend that normally I'm pretty clear about what I think I see. Forget whether I'm right or wrong. That's a separate issue. But I'm pretty clear about what I see. When somebody who's usually pretty clear about what they see tells you they're not clear about what they're seeing, that's the noteworthy point. And there's just a lot of conflicting signals. If I sent you out, and if I had a research system and I say, go find 10 really great things about the economy, they wouldn't have a hard time. If I said, go find 10 things that are really disturbing, they wouldn't have a hard time. If I said, find data that's being adjusted all over the place, they wouldn't have a hard time. And you add to that all the adjustments in the data, the response rates being lower. Yes, you can use private data, but the private data has a lot of noise in it, which is why we tended to use government data in the first place. And I'm not knocking ADP, but we always knew ADP data on employment was much more volatile, much less representative. They try. And then, of course, the BLS doesn't report. And the BLS doesn't report after 3 months of a lot of revisions saying that we basically had almost no job growth for the last 3 months, like 65,000 jobs total over the last 3 months. On the other hand, unemployment insurance claims came out 2 weeks ago and were terrific, very low. And you go, but then they didn't come out last Thursday. And you go, I don't know if that was a 1 week thing or it's a more. So you take, and then of course, all the uncertain we've talked about before, that's always in an economy. It's a politicized economy on top of that. I'm not very worried about the shutdown. That's theater. It's political rather than economic theater. But it's just harder. So whereas I would normally say, I think things are looking good, what I'd say now is this looks like a pattern, not just of employment, a generic pattern that could either say, you're going to look back 5 years from now and see it's a bump in the road. Like you put on 2 pounds over a 3 week period. And you look back and you say, you've done that, right? You're in terrific shape. There are periods where you put on 2 pounds over a 3 week period and it was a bump in the road, no big deal. There are other people who put on 2 pounds in 3 weeks and five years later, they weigh 100 pounds more. It's unclear whether this is a bump in a growth, which I think it is, or is this beginning of losing like 1.6 million jobs in the next 18 months? And they both look the same in that regard. And I said to somebody this morning, imagine you're watching a movie. Movie comes on. Guy comes in, you see an old guy laying in his bed, pillow goes over his face. They suffocate him, walk out. And that's the last thing and then they stop the movie. Is it a comedy? Is it a drama? Is it a whodunit? You don't know because you've seen a comedy start like that. Think of a Mel Brooks, right? You've seen drama start like that. You've seen whodunits start like that. We're at that odd moment. And normally I don't think we're there. And so caution would be what I'm saying.
And when you say caution, are you saying dig deeper for data? Are you
No.
saying put pencils down on investing new capital? Are you saying sell assets and hoard cash? What's define caution?
Okay. So the reason you want caution, let me continue the movie analogy. Let's let the movie play out 5, 10 more minutes because we'll see if the next thing we see is a joke, right? Or the next thing we see is a detective, or the next thing we see is a distraught spouse or something. That'll help. Won't define, but it'll help. So what's it mean? Only do what you have to do in the next 3 weeks, 4 weeks, and let a little more data come out.
But what's going to change? I mean, why is this any different than, I mean, let's go back to when the president unveiled his tariff policy. We all looked at that and said, whoa, this is going to be a big hit to the economy. I sat with developers in Dallas yesterday and said, have you all seen tariffs show up in your cost of building? No, we haven't. Have you seen ICE policies impact the people who are showing up to the job site to build buildings? No. So two things that pack up 6 months ago.
What they forgot to tell you is they're not building any buildings because the interest rate's too high. But that's a separate discussion.
But that's actually, but in this case, with the two companies I met with yesterday, no, they both have shovels in the ground and they're continuing forward with shovels in the ground. But to that, all I'm trying to say here is what changes in the next 4 weeks. The Bureau of Labor Statistics isn't all of a sudden going to have, relevant data after revising the last 12 months by 950,000 jobs.
What will be clearer? Let me just take, for example, one that they revised up second quarter GDP quite substantially. Was already a strong growth, and then it got revised up a lot. At the same time, they're revising down employment. Now, there's not a complete overlap. I just need a little more clarity about what's going on there. Those are very contradictory. Vegas is off, right? We know Vegas is off, and you could argue about by how much. Orlando's not off by much. So you see one where you'd say, well, discretionary spending is being hampered, but you see the other and you go, not really. So 3 weeks is not magic. I'm never an advocate of doing nothing for a long time. It's much better to do something and adjust as you go. If you don't have to do something in the next 3 weeks, month, don't. If you have to, do it. I'm not saying stop life. I'm flying to I'm flying to Europe, right? I'm not stopping life.
Well, okay. I guess we'll get a little bit more on all this as you and I continue to dive into the data during this conversation, because I'm surprised with the sort of like pause for 3 weeks with no seminal moment or event, whether it would be does the Fed continue on their trajectory of cutting rates? Do we have a stock market bubble, and we will know whether we have a stock market bubble because of X, Y, or Z?
No.
By the way, do you think that we have a stock market bubble today?
Let's go back. We will have hopefully the BLS comes back up, and we would have 2 months of data. The one that they didn't give us last week and the month that hopefully they give us.
And would
Just
you
for
trust
example,
that? And would you trust that given the revisions we've seen? And by the
I
way,
would
that's not a comment about the Trump
no,
administration
no,
BLS versus the Biden administration BLS. That's just
no,
the government numbers and the way they're taking that data and giving it to us with the revisions we've seen.
no. I totally agree with that. It would be 2 more months of data that I know how to deal with, as opposed to 2 months of data that I don't have. I would have 4 more weeks of unemployment insurance claims, and they are fairly robust and they are fairly real time. So it won't, by the way, hopefully we would get another interest rate cut from the Fed during that window. Um, but you can't pause forever. I totally agree. I forgot your other question
Are
about,
we in a stock market bubble due to AI
oh,
and data
so,
centers?
I have this view that the short rate interest rate is too high and is driving people to safe investing, right? And non taking risk. And somebody said, well, how do you explain the stock market? And I said, look, it's pretty simple. I think there's a giant bet going on about some number like 7 to 20 companies, that the bet is AI and the rush of money into AI is going to take productivity growth from, let's say, 1.5% a year to, let's say, 3% a year. Now, if that occurred and you had an extra 1.5% of GDP being created and the profit from that being captured by 7 to 20 firms, they're undervalued. They're undervalued. Now, I only take 3%, as an example of a big change. But I think those companies, those 7 to 10, 20, are being valued as if productivity is going to jump. Everything else, look at the Russell 3000, nothing special. Look at real estate, nothing special. So if you go to other assets, gold is an exception. If you look at other assets, their pricing is not unusual. What's unusual is if you've seen this huge rush of money into AI. I think, by the way, what's going to happen is it's going to have an R in the ROI sense. I think it's going to have a low ROI. And the reason is that if I gave you that much more money beyond what you've ever had, there's no way you can efficiently invest it. Doesn't mean it's going to be wasted. So it can generate an R, but it's not going to generate a spectacular ROI because you just cannot invest that much money wisely, quickly, compared to what you were geared up to as an industry. And
So
that's a real challenge. So I think that's why the stock market broadly is where it's at. Is it overvalued? It's overvalued if AI is like electricity, computers, internal combustion. That is, they're the source of the 1.5% a year. They're not overvalued if, in addition to the normal 1.5%, it generates an additional 1 to 2%. Time will tell.
yeah, okay. But so think about this. If you're one of those people who does believe that it's overvalued, that we're headed towards a dot-com bubble like we did it back in 2000, 2001, you'll see the equity market sell off significantly, but there are always winners in that. One of the things that I think a lot of people forget is that the Federal Reserve between 2000 and 2000, end of 2001, and obviously we had 9/11 in September of 2001, but they cut from 625 down to 150 during that 18-month period of time. As the dot-com bubble took tons out of the equity market, rates came crashing down, which then set up for very strong performance from industries like financial services, housing, commercial real estate, others after that step down in rates, obviously all tied to what the Federal Reserve did. Let's park the stock market on the side for a moment and go to where you are on what the Fed does, given their dual mandate. You right now are saying that inflation is sitting between 2 and 3%. If you strip out the rent increases that nobody's really seeing, and if you strip out owner equivalent rent that nobody's ever paid, that you're actually below the 2% run rate. You're in the high ones. So if you think that their mandate on that, with or without data, says that they'll cut on that side, you also have increasing unemployment at a rate that you see as being, if not cautionary, almost alarming.
Yeah, right.
Do they get to the 3 cuts that you and I made our bet on?
Yeah. I still believe it. I believe they would have cut. I'll never be able to prove what I'm about to say. I think they'd have cut 50 bips last meeting, except for Trump. And they're basically giving Trump the finger, saying, you're not going to tell us what to do. I think they would have cut in the summer 25 bips if it had not been for Trump, because they do not want to look like they're influenced by Trump. They do not want to look like they're bowing to that pressure. So you can imagine you're sitting there, put aside your political views. You do not want to bow to that political pressure. And now somebody shows up the morning of your meeting and says, we need to cut 50 basis points. I was just appointed to do it. What are you going to do? You're going to say, sounds like 25 to me. Sounds like 20. And by the way, that person is going to say, yes, everything you just said, employment's weakening, blah, 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 blah. And they're going to say, 25's enough. Let's see where to go. So I think actually Trump has delayed the interest rate cuts by all the bluster and the activities and so forth. Put aside whether the activities should occur or shouldn't occur, whether they're legal or illegal. He's actually hurting his case right now because they're behaving to protect their territory. It's almost like once I tell somebody they can't go into my yard, they really went in my yard, right? It's that kind of exercise.
So with that, if you think that you've got 2 more cuts coming in 25, what do we get in 26?
If you don't get 75 bips in 25, you get 50 and 25, and very early in 26, January, February, you get another 25. By the way, that will still leave it pretty high because inflation is for real around 2%. And if you add 75 to 100 bips on top of that, you end up around 275 to 3 is where it should be. And it's still at 4 to 4.25. So there's still plenty of room for them to do. And I always point out to people, I'm not saying they should cut it to 0. That is not, in fact, you can go back and look at Linneman letters all through the 2010s. I was saying keeping the rate at 0 was slowing the economy. It's like having, you can't have a rent of $1 million a month and you can't have a rent of 0. You're trying to find the sweet spot in between. And they were too low through the 2010s and it hurt growth, and they're too high now and it's hurting.
You mentioned that you're heading over to Europe tonight. You start this letter talking about the perception that foreigners don't want to come to the United States anymore, and tourism being down in the late spring, early summer, which is the most recent data we have. And then you turn to that perception of people shunning the United States into our foreign investors shunning US treasuries. And you give some exceedingly compelling data as it relates to foreign purchases of treasury bonds as well as agency paper, which to put it briefly, on a monthly basis, up until the pandemic, that number had been about $1.5 trillion on a monthly basis. It then, from the pandemic until the beginning of the Trump administration, had moved up to $2.5 trillion on average on a monthly basis. And for the first 5 months of the year, for the first 4 months, it was averaging about $3.5 trillion. And in April of this year, it hit an all-time high of close to $4 trillion of foreign purchases of treasury and agency paper. So that completely debunks the fear that foreign investors were going to shun the U.S. Treasury because of our fiscal position. Is that a false positive, Peter, or is that actually the fact that they have great confidence in the U.S., they don't mind our budget deficits, and as long as we're making money, they're going to continue to invest?
They don't have great confidence in the US. They just have even less confidence in France, Canada, England, Germany. Go through the list. And you know the headlines on France. You just had the prime minister step down. England has a revolving door. If Starmer makes it through the year, it'll be kind of surprising. I'm not political opinioning. I'm just saying whatever our problems are. So, Willie, you should have seen me when I was 21. I was really strong. I wasn't the strongest among 21-year-olds, though. I really wasn't. There were a lot of 21-year-olds that could leave me in the dust in terms of strength. At 74, I'm nowhere near as strong as I was when I was 21. But relative to 74-year-olds, I'm one of the strongest guys on the block. Not the strongest, but one. It's not that I got better, it's that everybody got worse faster. That's the situation they face, and that's the reality. Do you want to go to Russia? Let's go back versus 2015. 2015, you might have found somebody who said, yeah, I'll go to Russia. 2015, you could have found a lot of people saying, I'm going to go to Brazil. 2015, a lot of people say, I'm going to China. A lot of people saying England, Canada. All of those places have shown massively lower economic growth than we have, massively lower stability politically than us, even though our political stability could be a lot better. And I just take 10 years ago, when I say 2015, and there's nothing magic about it. Would you go to Russia today with your money? No. Would you go to China today with your money? No. Would you go to Brazil today with your money? I'm not picking. By the way, remember 2015, you couldn't go to JFK without 19 private equity people filling the first class of every plane going to Sao Paulo, right? I'm just taking that. And by the way, in 2012, same 2012 to 2018, same thing was true for planes going to Shanghai and Beijing. There are not a lot of private equity guys going to Shanghai and Beijing. If anything, they're coming from there, not going there. So that's kind of what's going on. And I make the point, I thought it was a clever point. It reminds me a lot of teenagers. They complain and they complain about how awful their parents are and what a terrible place it is. They show up for dinner all the time because it's the best place for them to eat. And that's the United States.
All right. So you and I have talked about the U.S. government debt extensively, and you have taken a position over quite some time that we can afford it. You put in the Linneman Letter that net wealth in America is at about $175 trillion. Go back and tell us where U.S. national net wealth was in 1952. I think it was 52 that you...
51. I did when I was born.
51. Where was U.S. national net wealth when you were 51? Take out the net debt and tell us why you feel that we can continue to spend trillions of dollars on the U.S. credit card.
So the backdrop of this is I'm 74 years old, and through my entire life, and I'm sure through your entire life, and you're a young guy, everybody says we can't keep running the deficits. We can't keep, and you know what? We keep running the deficits and we keep growing. So you have to question the narrative that says we can't do it if you've done it for 74 years. Okay, you have to look for some reason. You look at the reason. I happen to take 1951 for the writer sense of it's when I was born. That's the only reason I picked it. We were by far the richest country in the world, and 25% of the population did not have access to an indoor flush toilet. That was the richest country in the world in 1951. And in real terms, inflation adjusted, I was born into a United States that had the same income capacity per person of Bulgaria or Chile today. Okay, adjusting for inflation. All right, this is no, by the way, and you know that they're better in Chile and Bulgaria today because they all have flush toilets and they all have polio vaccines and they all have iPhones and they all have, okay, so to take your point, let's look at wealth. And the data is reasonably good. And it would say that we had about 800 billion in net household wealth when I'm born, and about 200 billion in federal debt. So if you net off, we had 600 billion. I'm doing these numbers from memory. We had 600 billion. Okay, let's flash forward.
Half a trillion.
Half a trillion. Yeah, half a trillion. Let's flash forward to quote today. By the way, these numbers do not include the value of all the assets owned by the federal government, mineral rights, forests, highways, etc. We're not valuing any of
Which
that.
Interior Secretary Burgum estimates is about $100 trillion, but let's park that to the side and not go there.
And I'm not taking off all the unbooked liabilities, right, that are out there. So I'm just saying, let's say those two wash, and I'm just focusing on something I can cleanly make. So we've gone from, as you say, half trillion, and that same number, that same calculation is 150 trillion today. Okay, 100. That's a 9.6% CAGR. I then broke it down the other day between the first half of my life and the second half of my life to make sure it wasn't all done in the 50s. And the CAGR over the second half of my life is like 6.8%. So it's still pretty amazing. So we went from a half a trillion to 150 trillion net worth. Do the following very, very simple math. Remember, the CAGR I told you is like 9.6. It's been 6.8 over the last 37 years. What if it's only 3%? What if the wealth only grows 3% a year? Okay, on 500, what that on a 1.5, that's 4.5 trillion next year. And of course it'll be volatile, but that's 4.5 trillion. The federal deficit is 2 trillion. So if you say we create 4.5 trillion and we indebt ourselves through the federal deficit by 2, we net have 2.5 trillion more, even though we ran a deficit of 2 trillion. By the way, how long could you do that? Forever. Forever. Now let's push it one step further. Suppose the wealth stays flat. Just doesn't grow. That is to say, the next generation generates nothing. Nothing. Well, what are the odds of that? 0. But let's assume it generates nothing. It stays at 150 trillion the rest of history. How long can you do that with a $2 trillion deficit? 150 divided by 2, 75 years. You could do another my lifetime.
Yeah.
It can go on forever. And that's how we've been able to do it. So here's what we've done, Willie. I'm not saying we should do this or shouldn't. I'm saying can. We decided collectively, this is the stuff we want to have the government buy for us, okay, or give to us, okay? You may like it, you may not like it, but we have decided that collectively. We then say, let's raise taxes now and do it.
Yeah.
And people look and say, no, don't want to do that. Okay. And then they say, well, where else can we get the money? And they say, let's reduce the huge bequest we're going to give to future generations. But we're not reducing the bequest. We're just growing the bequest at a slower rate. And by the way, I don't have a hard time slowing the bequest at a growing the bequest at a slower rate.
So
I'm still leaving them with staggering sums.
let me underscore that, because I think that something might have just slipped through in what you just said. What you're basically saying is don't tax inheritance higher, because that's not what the proposal is. The proposal is continue to borrow. And that continued borrowing is what reduces the inheritance that goes to the next generation, because
Yeah,
they're burdened with paying that, not that you're going to diminish what actually gets transferred.
exactly. And they're going to get the net net. So when I'm born, my generation had a half a trillion
Zero.
given to it,
Zero.
basically zero. And now you say today they got 150 trillion? Give me a break. I
So
mean,
the
and
one
when
other
people say we're robbing our children and grandchildren, I have two reactions. One, screw the little snots. They can earn it on their own, you know?
I told you to revise that. I don't think you would. I know you have great emphasis on that, but there are not many people on this call who are listening in who want to think about
Well,
their kids or their grandkids as little snot. So
but here's how I convince them that I'm right. If your child or grandchild says to you, stop living, because when you fly to Europe tonight, you're going to reduce my inheritance. Or stop living because as you live, you're reducing my inheritance. Anybody listening is going to disinherit them, right? Because you're going to say, I don't want my kids to be thinking that as I live my life, when I go to the ball game tomorrow, I'm reducing my kids' inheritance in some mechanical sense, but not really. Not really. I'm leaving them a staggering sum that is still growing. It's a staggering sum that's still growing.
So the one I want to shift here to housing, and get a little bit, if you will, out of 30,000 feet on the macro and down more specifically to commercial real estate and markets. But before I do so, the one other thing that I think, Peter, is really interesting for people to keep in mind is the following. There's a lot of talk about the wealth transfer that will happen from the baby boomers to the next generation. Estimates are that there's $90 trillion of wealth that should move sometime in the next decade to 2 decades, depending on life expectancy and what have you. But it makes me think back to your very, very important point during the pandemic about the acceleration of death rates. Therefore, a lot of people who typically would have lived for another 4 or 8 or 10 years died during the pandemic, tragically to those who lost loved ones during the pandemic, and therefore transferred that wealth, if you will, prematurely to the next
Prematurely.
generation, which then drove the ability for people to put down payments on single family homes and drove up single family home sales. And I think it's a very important thing that at some point, if this next generation is, we hear living paycheck to paycheck. We hear all of this as it relates to that the wealthy are getting wealthier, and that the down from them, you're not getting wealth distribution across it. This wealth transfer will by nature bring to this next generation a huge amount of capital that will allow for down payments on single family homes. And at some point, I would project that it will increase the amount of single family home sales dramatically once that wealth transfer cycle begins.
It'll happen slowly because the deaths are going to happen slowly, but I think you're absolutely right. Um, I don't think it happens in the next 10 years, 5 years,
You
but
don't.
no, I think it happens more dramatically because the reason is yes, the non baby boomers that are old have wealth. There's no doubt. But the bulk of that wealth is in the baby boom generation. And the leading edge of that is only 77. So you're just kind of what, five? And remember, it's the surviving spouse, which is likely to be the
Right.
female. You're still probably 10 years away from the real beginning of that wave. And then it picks up steam because the younger age of the edge of the baby boom is what? Is 59 or something like that. And so that's the window of big inheritance. Now, by the way, we've already seen it in a different way. We, how many kids are having their high-end student housing paid for by grandma and grandpa? How
And
many are having their apartment in New York at $5 a foot being paid partially by grandma and grandpa? How many have, go through the list, right? Tuition, etc., by grandma and grandpa. So it's happening, but it's happening in a, what do you want to call it, cash flow sense, rather than a corpus. Here's this
right,
corpus kind of matter. It's
right,
one thing to say grandma and grandpa are giving me, I'm not taking away from it, 3,000 a month. It's another thing to say grandma and grandpa left me, 400,000. I'm not
right,
talking about the mega. I'm just talking grandma and grandpa leave 400,000. Wow. Down payment, big down payment available.
right. The one other thing on that I would say, and then I want to go to housing, is that, your comment as it relates to our national debt and our ability to continue to add it on. Clearly, there are people there who say he's talking about asset value and not cash flow. And one of the big issues in all of that is, do you have the ability to continue to service the debt with the current tax rates and budget that we are going through every single year? You actually, in this Linneman letter, point out some of the things in the big, beautiful bill that you said were both misreported in the sense that there was no change to tax rates, really. It was an
Right.
extension, if you will, of the existing
Right.
tax rates. And then you talk about some of the things such as the liabilities that the federal government runs, that this is the first time that we've actually focused on that in almost, in generations as it
Yeah.
relates to, can we continue to fund Social Security, Medicare, Medicaid, and all that at the same rate that we have? But the point I wanted to raise here is this: the amount of activity going in both the public markets and private markets as it relates to capital gains is making it so that treasury inflows as far as taxes have just skyrocketed. And one of the things that I think we are going to see after 2025 is that the treasury is going to print something in early 2026 that talks about unprecedented tax income to the treasury, given the amount of capital markets activity that is going on. And so if you think about it from a cash flow standpoint, very clearly, are we able to fund our debt service as we add debt onto it right now, given what's going on in the capital markets and the amount of taxes that people are paying in capital gains? Without a doubt. The question would be, if you turn the other way and don't get those types of tax revenues, then you're back to people saying, oh, we need to raise the ordinary income rate, we need to raise the sales taxes, et cetera, et cetera.
Or we need to float more debt.
Right.
Or we just, we just float, we pay for the debt by floating more debt, right? That's the other way. That's an alternative. And again, that alternative has been a popular one, right? That alternative has been, we've been through a period of low interest rates, so it hasn't been so pressing. But if interest rates went up a lot, the other thing I point out, um, don't forget that the majority of federal debt, the payments on it are
So do I.
received by
So
either
do
the
I.
government or domestic
Right.
citizens.
Right.
So, yes, some of it's received by foreigners, and people forget that. It's why Japan has been able to run without huge wealth growth. Japan has been able to run it because they owe all the debt to themselves. It's a little Miller Modigliani. It doesn't matter what I call it. It's just a. I said to somebody the other day,
But
imagine if all the citizens in the United States held hands in a big circle, and they all gave a piece of paper to the person to their right, every one of them in a circle, gave a piece of paper that says, here's a loan for $1,000. The measured debt would go up, but there'd be no change in any economic condition because I got an asset and a liability. Now, I'm taking a very extreme example to drive that home.
yeah, I know. But you and I also both know that the reason the GFC happened and the reason that the GFC was so dangerous is that we lost confidence in the system. And so while that example is correct, at the same time, when someone doesn't know that that piece of paper they just handed to the right actually has the value in it, you lose the system. And so I think you're making a good point, but at the same time, our entire system is based off of confidence. And so the moment that, for instance, we would default on our own federal debt, we have a run on the banking system. We have a run on the federal government. And so while theoretically you sit there and say, yeah, we could do it, it would sort of be like, I'm a very significant shareholder of Walker and Dunlop. And you might sit there and say, oh, well, if they cut the dividend at Walker and Dunlop, and anyone listening to this, do not worry about that. I'm just trying to use an extreme example here, that Willy gets a lot of the benefits from the dividend on Walker and Dunlop. So that wouldn't be a big thing because he's just trying to manage the company better. I would tell you flat out, no. That would hurt. I wouldn't like that. And so I'm only saying to you, I get your example that we owe ourselves the money, but as you and I both know, the entire system is based off of the confidence that those payments are going to continue to flow.
That's why the two conversations we had earlier, one is we continue to create substantial wealth. And you can just name the great companies, right? Big and small, Walker Dunlop, big and small, Google, doesn't matter. Some guy who's got a home building company doing 82 homes a year, big and small, we create wealth. That's critical to that confidence.
Right.
And the other thing is that we maintain our strength relative to the rest of the world. And I would like to see us be absolutely stronger, not just relatively strong. And back to my little analogy of myself, I wish I had the strength I had when I was 21, but I do the best I can, right? So I'm not saying don't try to be strong. Critical to that confidence, though, I think is we continue to create. Take Germany. The last great company Germany created was probably SAP 30 some years ago. And I'm not knocking Germany, I'm just kind of saying it factually. If I sent you out and said, write all the great companies at least as substantial as SAP created in the last 30 years in the United States, you'd need 2 days to do it. That's what's critical to that confidence.
Right. So on LREI and housing, the two questions here. Let me start on this one. You say that about 70% of the faltering of GDP to trend line, given the pandemic, is due to an undersupply of housing. And yet, if you look at the home builders, Peter, you look at the big public home builders who, by the way, the independent home builder market is basically gone. You go back 20 years and there were lots of independent home builders in the United States. The GFC wiped all of them out. And today it's almost 60% of home building in the United States is done by the publics. And so it's become a big institutionalized business. And if you look at those big publics, they aren't building. They aren't growing the number of homes that they are building. And so you sit there and say, your estimate is we're undersupplied in housing by 3.5 million units. It's a big number. Okay, to give people a sense of that, the third largest home builder in America, Pulte, will make 31,000 homes this year. The third largest public is going to build 30, maybe they go over that and build 35,000. Okay, so to put it into, you got a shortage of 3.5 million. You sit there and you say, all you got to do is be a home builder. You can build them because there's insatiable demand for them. And that's not the case. And so I guess my question to you is, you continue to hone in on there's a lack of GDP, that if we got home building going, it would add a lot. It'd add a lot of jobs. It'd have a lot of GDP, all this other stuff. And yet at the same time, the home builders aren't building additional units. They're building to their budgets, but they're not going above it. Why is your analysis of supply and demand so wrong?
It's not wrong, it's accurate, but there are other issues happening. The other issues are, as you know, regulatory cost, regulatory burdens,
But everyone says that, Peter. Everyone sits there and says, "Oh, I mean, these home builders have years and years and years of land that's entitled. They can look out and they can sit there and say, over the next 8 years, we've got this amount of land. It's going to go into entry level, move up, and high-end active seniors. And they've got it all mapped out, and they've got 3 to 4 years of land entitled. And I get it. And I know that it's been an inhibitor, but the concept that they sit there and say that local governments can't get their act together to allow me to actually build on the property seems to be an easy excuse, is it not?
It's an easy excuse because it's true. Sometimes, why am I not playing Major League Baseball? I can't hit. I
No,
can't
but
hit a
I
football
don't think
or
the
a
demand, I
fastball.
don't think the demand is there. I mean, I have multifamily developers who sit there and say to me, the numbers don't work. I get
The
that.
the
Like
demand
yesterday in
is
my
not,
meeting that I was talking about, I said, what kind of a yield on cost are you building to? They
and
said,
that the one of one of the most important pieces of research I think I did in my career was back in 1990. And there was a lot of discussion about why people were not able to buy homes. And they kept saying income was not high enough and income was not high. And we did, along with Susan Wachter at Wharton, we did a very careful analysis. And we found it's not so much income. Income determines what kind of home you buy. Is it a big one, a small one? Is it 2.5 baths or 3 baths? Is it the corner or the middle of the block, etc.? What determines if you buy is down payment, is down payment. And there is a lack of down payment capacity. And it's partly because home prices have gone up because of the shortage. And it means you have to save longer to accumulate the down payment. And the second reason is young people have made the decision, and I'm not saying they're wrong, versus 25 years ago, young people have decided they would rather go on a ski holiday for a week and a Caribbean holiday for a week than to save that money, and they would rather go to the restaurant every week rather than once a month, rather than save that money. And they'd rather use Grubhub or whatever the delivery service is rather than walking or fixing. Now you say, well, those sound like peanuts. Do the math. They add up pretty substantially to you don't have the money for a down payment quite as soon. You put the shortage on top of that, and therefore the home price going up, accentuating how big the down payment you needed. That's why they're not doing it. It's much more about the down payment than the desire. Now you can say it is the desire. They could go back if they wanted. They could go back and say, real people didn't go to Europe. I mean, rich people did, but real people, the people who bought those homes, they didn't go to Europe
but I get,
25,
so I
50
get
years
all that,
ago.
but then, okay, so you're saying go long Caribbean cruises and go long Hilton hotels and ski vacations to Vail resorts. I get that. So then let's go back to where people are actually living. So if you're saying down single because people can't afford it, and very clearly in the home builder data of last quarter, it's very clear they're down significantly on entry level sales. It's the higher end sales that are holding up well. So
Of
your point
course.
about not having the down payment is exactly right. But then you go to net absorption of over 720,000 units in the multifamily space, T12 on Q2 to Q2. 720, more absorption than we've ever seen. And yet the rent bumps that everyone has been projecting, including you,
Yep.
haven't materialized. You're not, I'm in Dallas, Texas, the highest growth market in the country as it relates to job growth since the pandemic. Highest
Right.
job growth of net jobs, and we're going to go into this in a second, of any MSA. And yesterday, in meeting after meeting, I get from developers and owners, we have not been able to push rents.
And
So
it's
what
because
gives? What
supply,
gives?
supply. It is demand. One of the first lessons you learn in economics is that for 100 years, there was a discussion that it's all about supply. And then there was a discussion, it was all about demand. And then Alfred Marshall in 1914 or whatever said, no, it's about supply interacting with demand. So what you've had happen in multifamily is pretty good demand through all this. How is it so weak? Because supply spurted. And it was the supply side. If supply had come online at half the rate, you would see rents spiking all over the place. And it's one of the challenges I often get asked, tell me what a real good market is. And we had this conversation like 2 years ago, and I named a couple, like I think I named Detroit. And some people said, why the heck are you naming Detroit? And I said, because there's no supply, right? It's
So let's go to this slide because this is where you and I mean, look, you're talking about supply and demand, it's great, but this is real page rent growth versus your data on job growth. Okay.
Yep.
So this is the most recent real page data as it relates to T12 through Q3 of rent decreases across the country. Denver, as you can see on this slide, down the most dramatic of 7.7%, followed by Austin, Phoenix, San Antonio, Las Vegas, Orlando, Dallas, Nashville, Charlotte, and Jacksonville. Okay. Now, if you'd said to me in 2001 and 2002, what are your top growth, top sales markets in the United States? It would be that list of MSAs. Literally, our investment sales volumes in 21 and 22 were off the charts in those major MSAs. And to your point, those all got oversupplied. But as you can see on this chart, even though rents are down across there, the job growth that we've seen from your data over the last 5 years in these listed MSAs goes from a low of 5.5% in Denver to a high of 19.3% in Austin, and all of them are in low double digits. Job growth. Where are corporations moving? Where are people creating employment and therefore creating a need for housing? Now let's go to the next slide, Coco. So this slide shows you those metros that per real page data through Q3 of 2025 had the greatest rent growth, starting with San Francisco, going to Chicago, New York, Pittsburgh, one that you love, Cincinnati, another one, Kansas City, and finally, Newark, New Jersey. Okay. And as we plotted on here with your job growth numbers, you can see the actual jobs that have been created in San Francisco down 3.8% over the last 5 years. You can look at San Jose down 1.6%. And you can look at the biggest growth city of all these MSAs of Kansas City at 4.3%. So your comment as it relates to supply and demand is what is driving that rent growth. The question is, as a developer today, are you playing on that just supply demand play, or are you playing on longer term trends that say, I know that those high growth markets, whether it be tax rates, corporate relocations, where people just like to live, are going to drive the economy forward. And therefore my bet goes there versus going to somewhere where there's just a supply and demand imbalance today.
I always look at the supply demand. And in fact, I wrote about this about 15 years ago. High growth markets have a hidden risk. Houston, Dallas, whatever, have a hidden risk. What's the hidden risk? Great growth. Developers get a lot of development fees, right? Lenders get a lot of fees for the construction loans. The units will fill because there is growth, right? Do you get a lot of value increase in your asset? Nah. Or rent increase, as you say. And the problem is that demand generally is outstripped by supply in those markets. It's like people are more optimistic than a very optimistic reality. There's a second problem that's micro. That's not broad micro, I'm about to say, which is I have, I think you guys are helping us do it out in Dover, New Philadelphia, Ohio. We have 208 units. Nobody knows where it's at. It's like 29,000 people. I have 208 units. Nobody's ever going to have a better project. And if they do, I've made a fortune because the rents don't justify it. I never have to worry about, by the way, in the market I'm at, nobody's going to steal my property manager because there's no new projects being built. I don't have to worry about that. If I'm in Atlanta or Dallas, there's constantly new projects being built. Where are they going to go? They're going to steal my property manager, my people. And so I've constantly got to deal with that. Second, there'll never be a better project than mine in the market I'm in, right? There just won't be. That's because there's no growth, but nobody's leaving. I mean, there's minuscule growth. There's income growth, by the way. There's income growth, but not population growth. And you say, how can you make money there? And you make money because nobody will build anything. Mine not only will exist, it'll still be the best. Now I'm taking an extreme. Now let's suppose instead I build today in Houston. I know that a decade from now, 30% more will have been built during that decade because that population growth, et cetera. My brand new unit has now been outstripped in a matter of 10 years in terms of best amenities, best design features, et cetera, et cetera, et cetera, shiniest, newest, et cetera. Now, obviously, if you have a drop dead location, you can mitigate, you can do maintenance. But let's face it, it's like the NFL. You're competing against a new running back all the time if you're in a market like Houston. And yep, you lost 1/10 of a second on your acceleration. Doesn't sound like much. It's everything if you're competing in a market like that. So that's a hidden risk. So I think people get enamored by growth because it's great for developers. If a developer calls me and says, where should I go? I know they want the development fees. They probably want to flip, et cetera, et cetera. So you want to go where there's growth you'll never make money in New Philadelphia as a developer. There's just not enough action. You go where there's growth. But as an owner, you go to supply and demand fundamentals.
So essentially, what you're saying there is that our housing crisis, the cost of renting in major MSAs, is going to just continue to escalate, because if someone goes and puts new supply in there, you're going to be competed out of the market the next day, and therefore people aren't going to build to that demand, and therefore our major MSAs get underinvested in and people look to other alternatives. Is that, I mean, am I reading that right?
That's been going on now for 15 years. And I don't see a dramatic change. And when you throw not the national political scene, when you throw the local political scene, all those homeowners in those communities have almost no incentive to encourage development, right? Because they want their home price to go up. That's a big part of that wealth we talked about for them. And so if I can reduce the supply by protesting, showing up at city hearings, hiring an attorney, making a lawsuit, blah, 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 I'm protecting my wealth. And people are protecting their wealth at a local, and they've gotten good at it. You know, if you go back 30 years ago, that happened, but they weren't professionally good at it. There are people who are professionally good at this now.
So one of the things that I think is really interesting for those listening, if you really want to try and what is, you go through your various asset classes, Peter, in the letter. You put forth markets that you think by the end of 27 are going to be strong from an office standpoint, weak from an office stance, strong from a retail standpoint, weak from a retail standpoint. First of all, there is no one winner. Let me give everybody. There's no one market that Peter's like, go long in Austin or go short in wherever. But to your point, it's interesting to try and match up where you see a strong office market, for instance. So you see strength in office in places like Miami, Charleston, and St. Louis, which, quite honestly, if you'd asked me a quiz and said, list your top MSAs for office at the end of 27, I'm pretty sure I would not have put Charleston or St. Louis or San Antonio on that list. But then you also go to places like industrial, and you say, one of the strongest is also going to be St. Louis. So it's like, wow, St. Louis strong on office and strong on industrial. Does that necessarily mean it's good on housing? Is that where I ought to go build apartments?
Not much growth. So you're not going to get much action building, but you might get a lot of action holding and owning. And obviously, I'm not talking downtown St. Louis. You're talking about the metro. The metro has relatively slow growth and almost no development. And I like that dynamic. Now, you can't just go buy any property, but if you can figure out, and that's why I say like 2 or 3 years ago, we talked about Detroit and people, but I'm not saying go everywhere in Detroit. I'm saying go somewhere in Detroit because nobody was building. You get me a market where there's any growth and no building, it becomes interesting for a holder, not for a developer. And I remember when I first joined ULI in like 1985, and they did this survey, what is the best sector for apartments? And I'm thinking, well, it depends if I'm a developer or an owner. And what I found out is ULI was mostly developers because they all said the high growth markets. Absolutely, for developers, you want high growth of population, high growth of jobs. As a holder of the asset, not necessarily.
I got so much more to talk to you about, and we're out of time. $62 a barrel oil. One of the things you point out in the letter is that that is below the average since 1970, but above the inflation adjusted average since 1948, I think.
Something like that, yeah.
What, just on that, like at some point, data points are irrelevant, if you will. In other words, the economy
Correct,
is so different today than it was in 1948.
correct.
Should we be looking at the long-term average since 48, since 70, or actually since I don't know, the advent of electric vehicles? I mean, in other words, like where do you
Okay, if
take
you
a data point
really,
that says that $62 a barrel oil is super helpful to the economy?
well, you know, I like to point out, I just love charts and graphs, so I just like to put them because they look pretty. You raise a very good point. On oil, you could make a legit argument that the relevant time period to look at it versus is since fracking became a big phenomena. Okay, because that was a new technology. That was a
So,
real new
so what date
technology.
are we talking about there? In 1990s?
No, no, no. It was existent, but it wasn't being used. It really was like 2007. I'm doing
Okay.
this from memory. It came a few years earlier for gas than it did for oil, but and that just changed the world. And deep offshore drilling kind of changed the world. So you're right that things change. Um, I think oil, for example, is people don't understand how fundamentally changed oil is. Um, we're the largest producer of oil in the world. We're the largest producer of gas in the world. You go back to what 1974, we were a net importer of everything. It crushed us and so forth. And then you throw in things like um, uh, Guyana, and you look at Guyana, which has an enormous find, and it's a small country that has historically been very poor. You're running a small country that's historically been very poor. Don't you think you look at the Emirates and go, ha, pump
Yeah,
like hell? And they
sure.
got a lot of it. And a lot of it, I mean, like a lot of it. And they have no allegiance, they have no historic ties to OPEC. They just want to get rich. And whether they want to get rich as a citizenry or as a potentate class, that's a different question. But whoever wants to get rich. And so a major find like that really changes things. And that I don't want to call them a rogue because they're not rogue, but from a historic sense, they're a rogue producer.
I'm going to loop back to the beginning of this because you just talked about Guyana and the UAE, and you in the beginning of the letter you talk about Michael Jordan and Tom Brady as it relates to, you know, Jordan missing more shots than he made, and Tom Brady, some statistic you put in there, but at the end of the day, they're both goats and they will go down in history. I did see just yesterday, Peter, that Tom Brady's being paid $75 million to go to Saudi Arabia and play a touch football game for
Oh,
$75 million
wow.
dollars. And I just sat there and said, this world is, at least in my view, somewhat upside down when we take a former NFL football player and pay him to play a touch football game, more money than he made in any year he played in the NFL. Like for an
Yeah.
entire season,
Yeah.
well
Yeah.
more than he ever paid. And it does sort of sit there and say, at what point does, you know, I don't know. It makes you wonder what value is today. I think that that's what that asks me of me is what is value? Like, is Tom Brady worth 75 million bucks for a football game? I guess maybe he is to somebody in Saudi Arabia, just as
Not to
Ronaldo,
you, not to me, but to somebody.
somebody,
God bless. It's a brand.
somebody's got
By
a
the way,
lot of,
can I just you mentioned that little piece. Can I take 10 seconds to the context of that little piece? The
yeah.
context of that little piece. I live, for those who don't know, I live about 2 blocks from Independence Hall, and I'm involved in an organization called Historic Philadelphia. And the 250th anniversary of the signing of the Declaration comes up in July 4 next year. And I had attended the 4th of July 249th. And it's very moving. It's very moving when you read it, have the Declaration read, and you do, and it's very moving. And it occurred to me that the United States has done amazing things and has done horrible things. But when you enshrine somebody into the Hall of Fame, they focus on the passes they completed, the shots they made, the clips. They don't show all the clunkers that Jordan threw up, and they don't show the overthrown pass or the fumble. And my only context for that was celebrate this unique event that, and if you people who don't know the history, it's an extraordinary history that begins with that. And so the context was, please, for the 250th, come to Philadelphia and understand the great things, and they should be heralded, much like at a Hall of Fame celebration. You herald the great things that somebody did. That was the context.
Well, you do great things. The Linneman Letter is a great read. I love our quarterly engagement. Thank you for taking my questions. Safe travels to Europe, and I look forward to seeing you soon.
Pleasure. Talk to you.
Thanks, everyone.